Good morning, one and all. Welcome to the Street's Opening Bell here from Post 35 on the floor of the New York Stock Exchange. Today is Wednesday, the 26th of October. Is that right? I had to double check the date to make sure it's correct. Apparently it is correct. I'm your host, JD Durkin. Opening bell rung just moments ago by 3M. What a legendary company. This in celebration of the 2022 3M Young Scientist Challenge. Shout out to the good folks of the great state of Minnesota. Yesterday was a tale of 2 days. 2 days Tuesday. See what we did there? The first was the intraday session itself. It saw stocks up again, the S&P moving up in yesterday's session 1.6, the Dow 1.1%, the Nasdaq 2.3. Blue chips here have risen 11% this month alone. But the story since the close of trading yesterday has been the other version of Tuesday, and that is, of course, the hammering of tech stocks pushed down by the mega cap names reporting Q3 earnings after the bell yesterday. Tuesday, 2 different days. See what we did? After the bell yesterday, we did get numbers from Alphabet and Microsoft, both dropping after hours after misses. We now turn our attention to what is on tap for this morning's broadcast. We will break down more of what we learned in those earnings reports, plus news from Texas Instruments and Chipotle, and so much more. For more on those stories, let's now bring in our senior editor and markets correspondent, Martin Baccardax. Martin, good morning to you. First, before we get into everything after hours yesterday, everything with earnings, I do kind of want to first get your take on what the session itself brought yesterday and the continuance of recent gains in sessions before that. And I wonder if you prescribe the recent gains to some better than expected earnings, hopes of Fed tightening beginning to ease up. Is it a combination of both or none of the above?
Probably more on the Fed side than the earnings side, to be honest, JD. I think that the assumption of earnings growth heading into the third quarter was relatively muted at best. And what we are looking at in terms of earnings beats has to be set against the fact that most of the forecasts have been downgraded throughout the summer and indeed into the early part of the autumn. So whilst the street is clearing a low bar on earnings growth, it's not necessarily giving you the kind of injection in terms of corporate enthusiasm that you might expect. When you strip away the energy sector, third quarter earnings are going to decline compared to the same period last year, and they may only just eke out a positive gain for the 3 months that end in December. So it doesn't appear to me that it's earnings generated, even though for the most part what you will get is an uptick in the stocks and a broader market movement. But I don't think that that's supplying a longer term trajectory for stocks just now. I think it's more about the assumption that the Fed will begin, if not to pause, at least to recalibrate its plans for interest rate hikes, certainly not for next week, but from December and beyond. That's pulling back government bond yields, treasuries, and it's putting some downward pressure on the US dollar as well. I would say that those factors, JD, are probably more significant in terms of the gains that we've seen over the past 2 days than the numeric reality that we're seeing. Surprising that we're seeing that pullback in marketing spend, but it was simply articulated from Google in a way that we could listen to differently than we would have and did from Snap. And that's really why you're seeing such a pullback in tech stocks this morning. In fact, we're probably going to hive about $300 billion worth of value from the five biggest tech stocks in the opening hours of trading this morning. It will be interesting to see whether those losses continue through the day. But certainly, Google's beacon at the bow of the global economic ship is flashing far more red warnings than they were even just a few weeks ago.
So this conversation of ad revenue is really interesting because in times of an economic downturn, you often see the reverberations, Martin, when you have massive advertising companies begin to tighten their belts, especially since that is largely the revenue stream for a lot of other companies that rely on ads, and that's true, for newsrooms and so on and so forth. YouTube ad revenue here slid about 2% year over year, and it largely echoes, like you said there, what we saw with the Iowa caucus of the conversation, in other words, Snap. And I wonder what more we know about why we're seeing this particular decline in ad spend. And I wonder what else you've read or you're hearing or your thoughts are about what we might be in store for other earnings in the days and weeks ahead. This is what we already have.
That's a great question. I think from the YouTube perspective itself, we got a hint from Google last month when they talked about the changes that they are making in their short form video content and how they are trying to entice creators to come in and build their sort of content platforms within YouTube within a really more sort of generous revenue share. Google is going to give about 45% of ad revenue to these short form content creators. That's significantly higher than a lot of other competitors because they understand where certainly user attention is headed. And also they understand the way the market is being displaced, of course, by the rise in TikTok. Now, YouTube has about 1.5 billion monthly active users. It's firmly ahead of TikTok, but it's not growing nearly as quickly. TikTok has about 1 billion and growing. And they, of course, are the market leaders in terms of at least innovation in short form content. So I think the fact that Google wanted to make a big change to that was an indication that they saw weakening digital ad sales across the broader platform. And that's exactly what we saw, somewhere down to the region of just over $7 billion US. That was a contrast to the slow but at least growing tally that they had in ad sales, which came in, I think, at about 54.5 billion or thereabout. Slowing isn't great, but the fact that it expanded is good. YouTube was a negative, and it will be very interesting to see how they manage that TikTok challenge going forward.
Before we move on to Microsoft here, I just want to give you an opportunity to address anything specifically in Alphabet, given the behemoth that it is, that maybe I didn't specifically ask you about or you didn't get to allude to in your previous answers, because, this is going to be one of the big, obviously, rightfully so, bigger names that investors follow. And I wanted to see what else was top of mind for you before we moved on.
Ultimately, I think the company is interesting in its plans for hiring and indeed its plans for expansion. I haven't heard Google sound this cautious in a good couple of years, and really even a number of years prior to that, because of course the caution from the pandemic isn't something that we hope to repeat. So what we're seeing now, I think, is a little bit more pessimism from a company that is typically on the forefront of innovation and therefore maybe less or more resilient to macro reverberations. But really what came through in the conference call last night was a lot less optimistic, I think, than we thought. They're going to slow down in hiring. They see artificial intelligence and the advances there being maybe a cushion to the broader business models. But they still are so reliant on ad sales that it seems hard to imagine they're going to be able to shake that off, particularly when they are doing so against the headwinds of a stronger US dollar, which, of course, was a running theme throughout the call last night. And again, that doesn't appear to be slowing down anytime soon either.
All right, let's talk Microsoft now. That company faring better on earnings and revenue forecasts. However, we talked about cloud revenue yesterday here on the show. Microsoft did report weaker than expected cloud revenue. What more did we learn there from Microsoft when they reported?
Really, it was about the cloud, I think, JD. The fact that they saw Azure growth rate, their key sort of hybrid cloud product inside the intelligent cloud division, slowing down to about 35%. They expect it to slow further on a constant currency basis as well. In other words, stripping out the impact of the rise in the US dollar. So they can't pin it all to the fact that the greenback is up about 17 to 20% compared to last year. They are seeing weakness in spending from companies who not only are pulling back on ad spend, but also on investment plans. Now, there could be an argument to be made that cloud is probably a more efficient use of capital, and therefore, when companies begin to sort of tweak and calibrate their budgets heading into 2023, they will probably accelerate. And bookings were reasonably solid, it has to be said, for Azure and the broader cloud division. But nonetheless, those slowing growth rates, which have been pegged very specifically against the value of Microsoft's stock, were certainly important and very much in focus for investors last night. It's probably why, alongside the muted growth forecast for the company's fiscal second quarter, which ends in December, that you're seeing such a big decline of the stock today. It's an expensive stock. For the most part, it has been leading the big tech names, even though they've all been significantly lower this year. So I think, again, the assumption, if you were pinning your valuation on what you are seeing in cloud and Azure, and you're seeing those growth rates decline, you simply have to recalibrate your assumption for the stock price. And again, it's probably why you're seeing a bit of an overreaction today in Microsoft stock.
Is it fair to say both Google and Microsoft here are showing signs of being hit by a slowing economy? I mean, I think people are going to look at these numbers here out front and now start to have a bit more trepidation. If that is a fair reading of it, what happens next here, Martin?
No, I absolutely think they are indicative of the weakness that we're seeing in the broader economy. And I think to some degree, because the weakness is a little bit more difficult to sort of visualize than it has been in the past, because the labor market is still reasonably strong. It's still very strong, in fact. I mean, we're looking at headline unemployment numbers that are still in the mid 3%. Those are near historic lows. Those aren't indicative typically of the kind of conditions that we see heading into recession. We're also seeing relatively resilient consumer spending as well, even in the face of this rampant inflation. So those twin conditions are kind of a head scratcher, I think, for a lot of economists as they begin to sort of try to explain exactly why we are headed into recession. Now, the housing market is rolling over. That's a worrying condition. Inflation doesn't appear to be decelerating to the way that we would like. That is also a worrying condition. But I think now that we have put some flesh on the bone with respect to these forecasts from two of the biggest companies in the world, we're getting a slightly better understanding of where it is we're headed from a growth point of view. And therefore, I think you're absolutely right. People are going to see this in that context. I really feel, JD, that that's why we are seeing the decline in the dollar that we saw overnight trading. We're down to the 3-week low and two significant back-to-back daily declines because people are paring bets on Fed rate hikes in December. And we're seeing a big pullback in Treasury bond yields. And that's largely because they move inversely to prices. Investors are buying Treasury bonds because they see it as a safe play in the face of slowing growth. Now, in the immediate term, lower bond yields are going to boost equity valuations. But in the longer term, they portend more concern about growth than they do about immediate market movement. So whilst we might see some stock market resilience today and through the week, that decline in bond yields will soon be seen as a negative rather than a positive. And I would imagine that will happen very quickly after the end of the third quarter earnings season.
So then, if I'm not mistaken, at least for the time being, then you got your pullback in your bond yields, you got at least some chatter and at least some speculative hope perhaps that the Fed only goes 50 basis points for the December meeting as opposed to what we've had now for many months, which is 75 basis points. And you've also got, which is probably welcome news, like you just said, the greenback starting to come back down to earth, at least for the time being, dare I say. Maybe there's a little bit of short-term optimism, but to your point, doesn't necessarily seem as if all of those factors may stay in play for very long, and if they do, they might be a good thing now, but they might not be in time. That's a fair read.
I think perfectly fair read, JD. I think ultimately you want to look at stock prices in two ways. Are they fairly valued today, and are they giving you a reflection of how the company is going to generate earnings, revenue, and ultimately earnings, and perhaps even dividends going forward? Now, to some degree, what you can argue is that the decline in bond yields and the pullback in the dollar is giving you a bit more confidence about pricing today, but ultimately pricing and the fair value of stocks going forward is going to be more predicated on companies' ability to expand revenue growth, expand margins, and increase profitability. That's incredibly difficult to do in an environment where the broader economy is slipping into recession. So I think you've put the nail on the head with respect to how it's viewed and therefore probably how it will be played out in market performance over the coming week.
Yeah, we talked about what the strength of the U.S. dollar might mean specifically for Microsoft and a company that makes so much money overseas, and for many companies that make so much money overseas and have to
Yeah.
repatriate that money back stateside and say, oops, that's not a very favorable conversion for us right now. And that's certainly the situation that a lot of big companies find themselves in, and they might for some time. You want to talk a little Texas Instruments? I like the
Yeah.
semiconductor space. In general, do you enjoy writing and reporting on the semiconductor space? It's kind of wonky to people, but it's also very
Yeah.
cool if you're into it. You like it?
I do. I wish that I had a better sort of engineer's mind when it comes to the chips themselves and their interaction with the components that they drive. That isn't necessarily my gubbin, as we might say in Britain, but it's nonetheless something that I find fascinating. And I'm learning a little bit more as I go. So I tend to look at these companies more from a helicopter view as opposed to down in the trenches, simply because my expertise is lagging in that regard. But to that point, Texas Instruments is a great company to look at because it has the broadest expansion of market share. There's about 100,000 customers for Texas Instruments all around the world, and their chips are in everything from cars to refrigerators to analog devices to mobile devices and everything else. So their view of chip demand is very comprehensive and therefore something that we should absolutely pay attention to. And they are seeing muted revenue growth for the 3 months ending in December. They had a not particularly great third quarter as well. They're looking at revenue somewhere in the region of 4.5 to 4.8 billion for this 3 month period that we're in now. That's below analyst forecast. So it does speak to the chip sector weakness that has been expressed by companies in Asia and certainly here in the United States as well. But the breadth of their market share, JD, is a big reason why this company is very sort of indicative of where we're headed compared to some of the more specialist rivals.
There was a phrase you used. I don't know if it involved the word coven. What was it? You said it's a British phrase. I did miss it because I'm going to ask you about it.
I forgot about that completely. Gubbins is the phrase, JD. Effectively, expertise, I suppose, is the best way to put it.
Oh,
yeah.
I like it. What was the other one we did a few weeks ago? Something about a beer, but I'm forgetting the full phrase.
Oh, small beer. There we are.
No small beer.
See?
Right, exactly.
Exactly.
How could I forget? Okay, I like including this one as well. So to this point about Texas Instruments, obviously it's the type of company could be a bit of a canary in the coal mine, tells us a lot. Company did slide after hours, like you said, at pointing to an overall semiconductor industry slump. You did a great job there helping us better understand what we can extrapolate or take away from their numbers. The company's chief financial officer over at TI seemed unsure if this was attributable to customers facing too much inventory. We talk about the inventory side of things all the time. Or if customers are starting to come back because they have legitimate personal concerns about the economy or the direction we're heading. And I wonder how you feel that a company like this, so crucial to the semiconductor space, might fare if we have a recession in 6 to 9 months, if we're not there already.
No, indeed. I think they're going to fare poorly as a result, and I really think a lot of the semiconductor companies will do so as well. I mean, we have the added component, JD, of the fact that the U.S. government is restricting some of the more technical chip sales to China-based customers as a result of the ongoing trade dispute between Beijing and Washington. Some of it certainly justified, but nonetheless, it's going to put a hole into the revenue forecasts of some companies, less so Texas Instruments, because it doesn't really deal in that space to a great degree. But some of its rivals are certainly going to suffer as well. But I think your point is a good one in the sense that it is very difficult to sort of pull away the impact of oversupply from the issue of muted demand. The supply issue is one that has been sort of uneven since the COVID pandemic because supply chain disruption rippled through the entire sector from Asia all the way to the United States. And it really is kind of unknown to exactly what degree that oversupply ended up, how we got to where we are today, because some of the mechanics in sort of estimating it are flawed, shall we say, at that. Demand also is sometimes difficult to predict because it can change quickly. But I think at present, we are looking at probably a lot of companies which have a decent amount of inventory on their books at the moment. Some of the chip makers might have to take a write down as a result of it. Intel reports tomorrow, and the expectation is that they will absolutely do so. But I think the demand component will end up being more important, and certainly more important for Texas Instruments, but also really for all of us who are looking at our expectations for broader economic growth, because I think in our younger days, the industrial companies were more of the beacons in terms of where we were headed on a growth perspective. Now it's a technical world, it's a technical economy, and all of that is powered by chips and semiconductors. And that is where we need to get our early signaling from today. And we got a portion of that last night from Texas Instruments for sure.
Absolutely. Speaking of another name we also got results from last night, let's talk Chipotle here. That company saw a solid quarter and its recent price hikes. We talked about the Chipotle price hikes, a little bit more money for your favorite burrito. The company says that helped boost revenue for Q3, but do you think, Martin, that Chipotle will continue to see high sales, even as fears of an economic downturn loom? We've heard from the Pepsis the last few weeks, right? And the Coca-Colas, they say, despite the pressures, people still want to spend money on their favorite drinks and snacks. Is that an argument for Chipotle as well? Or is that going to be a little bit too high of a price point for a lot of people if they start to feel the squeeze a bit more?
It's such a great company, isn't it? I wasn't able to dig into the Chipotle numbers in the way that I would like, but I did see some commentary that was interesting to me. I think it was their CFO who said that they were seeing resilience in higher end customers, those on with earnings of more than 75,000, but some pullback in spending from those at the lower income level. I don't know where they were able to find that data. I'm sure it's valid. They must do surveying of their customers on a comprehensive basis in order to understand that. But they have had a remarkable amount of resilience in spending against those high prices. You're saying 13% price increases. That's very, very significant for anyone to absorb, regardless of where they are on the income scale. But it speaks to the brand power. And Chipotle is, every time I am in a restaurant, and it doesn't matter what state, it is always busy. The line is always very long. It moves quickly. People behind the counter work incredibly hard. But Chipotle is reliant on a couple of things that are difficult to continue to control. And that, of course, is input prices with respect to food, avocados in particular. But secondarily, they need a lot of staff behind the counter, given the structure of how they put their food together. And of course, we understand how difficult that is and how expensive it can be. So given all those conditions, it's remarkable that Chipotle has been able to do as well as it has.
Yeah, absolutely. We've been seeing better than expected earnings across the board. Any sentiment here, Martin, that analysts are lowering their expectations as they start to price in a potential recession? Or are companies on the street resilient amid economic pressures? What stands out to you?
I think the assumptions are going to have to be changed for the fourth quarter as a result of what we've seen. Again, we have cleared a reasonably low bar, I think, with respect to earnings expectations for the September quarter. They were lowered throughout the summer, and the fact that the beat rate, I think, is somewhere in the high 77% range, and that's historically pretty good. But we're not going to hold that, I shouldn't think, throughout the whole of the earnings season, and as a result, there's going to have to be some downgrade for assumptions into the final 3 months of the year. At present, we are expecting earnings to grow modestly, somewhere in the 3 to 3.5% range for that 3-month period. But stripping away energy, the growth rate is only going to be about 0.4%. My suspicion is we will turn negative on that assumption reasonably quickly, particularly after last night's numbers. And if Apple and Amazon are similar in their pessimism to Google and Microsoft, then we'll absolutely be looking at a very different earnings picture as a result.
Speaking of a picture for the future, I think we're about 13 days now, if I'm not mistaken, from an election, and I wonder,
Indeed.
The White House, if you're a Democrat, if you are the incumbency in Washington, do you suspect here, given the start, the unceremonious maybe now start, at least to the tech side of earnings, are you in for a rough stretch of economic news, headlines you don't want in the next 14, 13 days to contend with as Democrats make their final pitch to voters to say, please keep us in office?
No, I think it's very possible, and this probably speaks to the reason why we saw that extraordinary letter from Sherrod Brown sent to the Federal Reserve yesterday, asking them to reconsider their interest rate policies. That really does put Fed independence into question, and it suggests that the Democrats are certainly concerned about the direction of the economy heading into the midterms. And the results at present don't give them a whole lot of confidence. We've seen consumer confidence levels yesterday deteriorating for the first time in 2 months. Clearly, people's assumption about broader economic growth is going to be calibrated to stock market performance. If there's a run of declines heading into the November voting date, that's going to influence voters as well. And there's one other aspect, JD, which I don't know is getting a lot of press, but I do think it's going to be important. Gas tax holidays in many states, many of them Republican, are going to expire on the 1st of November. And therefore, the declines that we're seeing in gas prices are going to stop and actually reverse in the early parts of the month. That might be an interesting optic for people who are undecided heading in to the midterms, because gas prices do tend to be a very sort of emotive issue for American voters. So the timing of that, I think, is interesting as well.
Absolutely. Okay, time now for our rapid fire section here. A handful of other topics that somehow and possibly we have not yet covered on the show, because Martin and I always cover a lot. Okay, first up, let's talk Visa. Is the company's optimism, I wonder, in consumer spending justified? What say you?
It seems to be, JD. I think to some degree they are seeing cross-border spending in the way that American Express reported increasing. And I think a lot of it is linked to the travel boom. Certainly travel spending is a big part of Visa's forecast, and that doesn't appear to be slowing down because we had very optimistic outlooks from all the big US carriers as well. So I do think there's some justification in that. Some investors were a little bit concerned about Visa with respect to its commentary on bad loans within their credit card system, and maybe they're being a little bit too rose-tinted in terms of how they see it. American Express, of course, set aside about $800 million to cover the potential for bad loans. But I do think that Visa's forecasts are probably solid, particularly when you set it against the travel boom, which does appear to be continuing heading into the end of the year.
All right, let's talk Boeing. That company reporting for Q3. Is the company primed for takeoff, or will it remain grounded?
I'm amazed that Boeing stock, I haven't seen it really since the start of trading, but prior to the opening bell, it was only down about 1% after what looked to me like a real grim set of third quarter numbers. Another quarterly loss, a $2.8 billion charge taken for the Air Force One program. And missing on revenue, it really wasn't particularly solid, but it didn't appear that investors were being that sort of reactionary to it. So I do want to get into the conference call to understand it a little bit more. They had a solid third quarter in terms of airplane deliveries. They were just over 90, and they're going to have to accelerate that into the final months of the year in order to meet their target of being positive on a free cash flow basis. I think that's going to be a challenge, JD. But again, I do want to get into the conference call to understand it a little bit better, because I was surprised that the reaction wasn't as visceral. But maybe that's simply because investors don't have the same faith in Boeing as they do in these big tech companies. Sometimes that is more of an indication of why you're not seeing a reaction than the numbers themselves.
Absolutely. Let's talk Meta. Those earnings are also coming up. The artist formerly known as Facebook, I guess technically still is. Are we expecting more declining revenue as the company continues its, I use the word rebrand. I guess it kind of is a rebrand, right? I mean, of course it is. It's like a whole new name, new commercials. You know, I don't know. What are we in for? Whatever you want to call the company.
I can't imagine it's going to be good, JD. I really cannot. We're looking at sort of certainly weaker earnings writ large compared to last year, and a decline in revenues to, I think the number I saw was about 27 billion. They are going to obviously suffer from the pullback in ad spending that's been articulated by Google and by Snap and virtually everybody else in the social media space. And they're also pouring just more and more money into this metaverse project. And a lot of investors are getting impatient and asking the company to sort of rethink the push into a component of the digital and virtual economy that no one really asked for. And it's eating up a ton of time, it's eating up a ton of executive energy, and it's just incinerating a great deal of profit along the way. So I do expect there to be a certain amount of commentary with respect to the metaverse investments going forward, discussion about the way that ad spending has been pulled back, and probably some blame laid at the feet of Apple for their changes in privacy rules, which prevent Facebook from tracking their users in the way that they would like in order to give them targeted ads. But broadly, JD, I don't expect this to be a good quarter for earnings, and I will be terribly surprised if there's anything positive for the final months of the year that comes out of it.
And as if all of that weren't enough, Martin, for the busy week that has been, I mean, this might be the week. I don't know. Maybe the news has changed and I saw it last. Might be the week Elon Musk actually almost maybe kind of, will he, won't he, finally close on the Twitter deal. Is this actually going to happen?
Well, my favorite American philosopher is somebody I'm sure that's near and dear to your heart, JD, and that's Yogi Berra. And he famously said, "It ain't over till it's over." I am not going to pin my hopes on this deal being done until there is ink on paper, and maybe even beyond that. But it does appear the Twitter shares are very close to the acquisition price of $54.20 per share. We're just underneath that, and the highest that we've been since the deal was first announced first floated in early April. Reports suggest that Musk has told his bankers to get ready to fulfill their commitments in terms of the loans that they are prepared to provide. And that does suggest that the deal is going to come to fruition on Friday, the 28th. But of course, there's still the overhang on Tesla stock, and indeed how much, if any, Musk may have to sell in order to fund his portion of the $44 billion price tag. And Tesla shares have not hit a home run for the first 9 months of the year, and indeed beyond. So that overhang is certainly significant in a slowing economy. That will be interesting to peg through. But ultimately, JD, we could be very close to the end of a saga, which I think all of us are simply just, we're fatigued by, to be polite.
Yeah, absolutely. I have a favorite Yogi Berra-ism. He famously, when they were on a road trip for the Yankees, and his manager happened to call his hotel room in the middle of the night, and Yogi Berra sheepishly woke up and walked over to the phone, and the manager apologized and said, "Oh, Yogi, I'm so sorry. I didn't mean to wake you." And Yogi Berra said, "It's okay. I had to wake up to answer the phone anyway." What a wit on that man, and I appreciate a good Yogi Berra shout out. Nonetheless, pride of North Jersey. Martin Baccardax, thank you for taking the time. What a dizzying array of topics we got to, and what a week it will continue to be. I appreciate your expertise and perspective always.
Lots more to come. You too, mate. Thanks a lot.
You're not kidding. That's it. Hope everyone's got a seatbelt for earnings as it continues this week. Wow, what a week. That's going to do it for the Market Open here from the floor of the NYSE. There it is behind me. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. We'll see you tomorrow.